In this video, what we're going to actually do is we're going to go over a couple of examples of loan modification agreements. Okay, and these are all public information in the deed records. All right, so we're going to go over two of them. Now, the loan modification is going to give you all the terms, and that's what this is on this property. Okay, so back in 2006, this person bought this property for $70,000, and their unpaid principal. So if they were all caught up today, their unpaid principal balance was about $52,000. You can see that right here. Okay, but because they fell behind and wanted to figure out how to make the payments more affordable, what they ended up doing was the loan modification. Now, here's what I want you to consider. All right, now their new principal balance. So remember, loan modification, you're basically getting a new loan. So what they did was they got a new principal balance for $60,000. But here's the catch. This is now going to be another 30 years of payments, okay, on the $60,000. So 2006, and right now it's 2024, it's about 18 years. So they're a little bit more halfway done of paying off their loan, and now they have another additional 30 years. So this is why I really want to highlight this so that you understand, if you decide to go through with the loan modification, what you're actually up against and what you're going to be doing. Because a lot of people aren't talking about this. Your loan officer, your lenders, a lot of times they're not going to go into details or tell you this. Okay, so now we have the $60,000 in 30 years, and this is the home affordable modification. All right, and this was done in 2021. So that means in 2051, that's when their loan will be paid off. Okay, now we're going to go over another example here. So this individual bought the property in 2017 for $310,000. Okay, so that was about 7 years ago. $310,000. Now, the new loan is now for $314,000. Okay, so just right here in 2023. All right, so actually 6 years into their loan, they ended up doing a loan modification. So now it's actually even more than what they originally pulled the loan out, $314,000. But here's the catch. So you see that there's the interest rate of 6.25%. So I guarantee you back in 2017, they actually had a lower interest rate. But what the lender did is, remember my last video I talked about, if you increase the interest rate, your payments are going to be more a month. But the whole purpose of a loan modification is to make your payments more affordable, your monthly payments. So what the lender did was they went up on the interest rate, right? They went up on the interest rate, but they extended the loan term. So now this one is actually 40 years. So for 40 more years, they were already 6 years in, but for 40 more years, they're going to be making payments. Now, because they did 40 years instead of 30 years, the monthly payments will drop. Because if they just went up on the interest rate but kept it at 30 years, the payments are going to be more expensive than they originally was. So, but for 40 more years. So the question is if you decide to do a loan modification, you got to ask yourself, do I see myself making pay? Maybe you're 2 years in, maybe you're 4 years in, 8 years, 10 years in. Do I see myself making payments for another 30 or 40 years? Because you're restarting the clock. And if the answer is yes, and if you're okay with that, then a loan modification would be an excellent way to stop the foreclosure and for them to modify your loan to make it more affordable. But you got to make sure that you're asking these questions and see if there's other ways that they can look at modifying your loan rather than extending it for 40 years. Okay? So now over here, you'll see that their principal and interest is $2,100. Now that does not include the escrow, which is taxes and insurance. Okay, So for 40 more years, they're going to be making payments $2,100. Again, does not include the taxes and insurance. When they were already 6 years in to the loan. All right, so remember that there's a few options on how they do it. Remember we talked about the partial claim. So if you fell behind, let's say 20, 30,000, they put that on the back end, but they don't really modify your loan. So they keep the monthly payments, everything the same, because maybe you could actually afford the monthly payments. You just ran into a temporary problem. But if you're needing to get your payments down and make it more affordable, this is where you start to see them extending the loans and going up on the interest rate. Because we talked about there's a rate reduction, but not in today's market because they're not going to go down on the interest rate. They got to go up. So keep that in mind when you're looking at these loan modifications, okay?